Morning, everyone, and welcome to our first installment in our three-part webinar on liability management transactions. I'm Anthony Canale, Covenant Review's Global Head of Research, and I'm joined by my colleague Scott Josefsberg, who's Covenant Review's U.S. Head of High Yield Research, as well as my colleague Ian Feng, who's our Senior Director with the U.S. Leveraged Loans team and the author of our quarterly series on U.S. liability management transactions. So in today's installment, we'll be discussing an overview of liability management transactions, and in particular, we'll be focusing on uptiering transactions. The second episode in this series will be focused more on drop-down transactions, and then the third episode in the series will be focused on double dips and other liability management transaction structures. So let's kick things off by answering the basic question: what is a liability management transaction, or LMT? Well, the challenge here is that there's no formal definition to what this term means, but at Covenant Review, we generally consider an LMT to be a transaction by a distressed borrower or issuer that utilizes existing or amended contract terms to manage long-term corporate debt liabilities with some creative out-of-court solutions. Obviously, this can significantly affect creditor rights, collateral pools, and recovery values as the capital structure changes as a result of the LMT. So with that in mind, we have a chart here of LMEs by year that we've observed at Covenant Review, but I'd like to turn it over to Ian to speak more closely to what we've been seeing on a quarterly basis and an annual basis.
Yeah, thank you, Tony. So the short answer is we are on track to surpass 2024, where we tracked 46 individual liability management transactions. This chart here is through Q2. I recommend those who are able to review our latest quarterly report, which is through Q3. And you'll see our numbers are now close to the high 30s. So we would expect to exceed 46 by year end. And just to highlight again, or emphasize again what Tony mentioned, there is no formal definition of what an LMT or LME is. If you were to ask 10 practitioners what they think an LME is, you'll probably get 10 similar but not exactly the same answer. And that can often lead to differences in how different firms will track LMEs, although I think if you ask any firm, they will all say that the number of LMEs overall is increasing over time. The way I tend to think about LME, though, is it's essentially a transaction that violates some underlying norm under the relationship between lenders and borrowers or issuers. Maybe a more simple or colorful way of saying it is it's a transaction where at the end of the day, one party would like to punch the other party in the face because something has been violated. Some rule or unspoken tenet is no longer the case. And that can be pro rata sharing, sanctity of collateral, or some other aspect of the deal.
I would add to that there's almost inevitably a coercive element that leads to these feelings that you just mentioned, where creditors that otherwise would not want to participate in a transaction are having to give up stuff and being otherwise coerced to go ahead and do that, whether it's by a sponsor, whether it's by an issuer or a borrower, or by other creditors, quite frankly, in creditor on creditor violence.
Yeah, absolutely.
So with that, we'll take a look at some of the common types of liability management techniques that we've seen in the market. And obviously, this is not an exhaustive list. And with the brilliant lawyers at many of the large law firms who design these things, there are many exotic flavors of each of these common liability management techniques. We'll go through them briefly and then focus on, especially in the third webinar, some of the other structures that we've seen in the market. So what are up-tier transactions? These are usually what people in the marketplace refer to as, pulling a Serta. And the general idea behind an up-tier transaction is that, there's an exchange of existing debt or the layering of debt with a higher priority with credit support from largely the same assets. So if you're in that capital structure and you have credit support from the same assets, you're being leapfrogged, or new debt is coming in on top of you that has better credit support from the same assets. For drop-down transactions, also known as pulling a J-Crew, even though I will note that drop-down transactions were happening long before J-Crew actually happened. In those situations, you see assets are dropped down into a structurally senior entity in connection with incurring new, better debt or at that entity, or to do some other creative transaction. And so then there's this relatively new entry to the liability management techniques field, the double dip or the pari plus transactions. The best example of that is at home. And in this LMT structure, basically the idea is to create multiple recovery claims for creditors in respect of the same dollar of new financing, to set up multiple recovery streams in respect of the same financing. And obviously, you have this catch-all miscellaneous idea, the combination of some of these above techniques, as well as other structures that we will also get into. Ian or Scott, do you want to weigh in on any of these before we jump?
I would say that for Serta 2, it's not the first up tier. Just as J.Crew was not the first J.Crew, Serta was not the first Serta.
So for an up tier transactions overview, I'll throw it to Ian and Scott.
Thanks, Tony. I'll jump in on this one. So like Tony mentioned, the up tier transaction is basically a subset of creditors leapfrogging remaining creditors on the same collateral assets. And when we talk about pulling a Serta today, we're really often talking about first lien creditors getting primed. And for guys like me on the high yield side, we're kind of used to seeing up-tiering transactions for a long time before Serta that didn't involve the first lien. In the high yield market, exchange offers of unsecured bonds for second lien bonds have been fairly common for years. And we saw tons of them in the energy space in 2015 and 2016 when commodity prices were dislocated, and again in 2020. And these had a lot of the hallmarks that we see in the Serta transactions now, where they were done by a subset of creditors. There weren't necessarily public exchanges. Not everybody got the opportunity to participate. And people were upset about them, but people didn't necessarily kick and scream the way they did when Serta happened. It was really when first lien creditors started getting primed that a lot of market participants freaked out, for lack of a better term. And so the idea here is that the expectation was, because creditors are in the first lien position, they don't expect that there's an ability to get primed. And in the vast majority of deals, there is no priming capacity built into the documents when you're in a first lien loan or a first lien bond. So when we think about what are the enabling provisions in a first lien loan or bond that allows for a Serta-style up-tiering transaction, first and foremost, we look at the amendment and waiver provisions. Because, as I mentioned, typically, first lien documents do not have priming capacity built in. There may be some situations where there's a little bit of capacity for a super senior revolver, but still, for the most part, most deals don't have super senior capacity built in. So when we look at the amendment and waiver provisions, the general rule is that most provisions in a loan or a bond can be changed with majority consent. And by majority, we mean the consent of a majority in principal amount of the debt outstanding. However, the amendment and waiver provisions also contain a list of things that we typically refer to as the sacred rights. And those are things that can't be changed with a simple majority. Those are things that require some supermajority or all affected holder consent to change. Now, this is an area where historically bonds and loans have been different. What happened in Serta is the Serta loans did not require any heightened consent requirement to subordinate the loans, either in right of payment or in terms of lien priority. And so why don't we back up on that and talk about those two different kinds of subordination, because those are different ways to accomplish an up-tiering transaction. So I said subordination and right of payment and subordinating lien priority. So subordinating and right of payment has nothing to do with liens. For the most part, most of the debt that we see in the North American market is senior debt, senior unsubordinated debt. So when you're looking at a senior unsecured bond and a first lien credit agreement, those are considered to be equal in right of payment. Payment subordination is sometimes also called full subordination, because the way that that subordination is accomplished is if you have a subordinated instrument, there will be a subordinated section in the there will be a subordination section in the document that says, by becoming a creditor, you agree that you will not recover a penny until the senior debt is repaid in full. So it's also sometimes referred to as full subordination. Then on the other hand, we have lien subordination. Well, I said an unsecured bond and a first lien loan are equal in right of payment. We all know they don't rank equally. The first lien bond is senior to the extent of the collateral, and that's called lien subordination or effective subordination, just like a first lien loan is effectively senior or lien senior to a second lien loan or a second lien bond. So in Serta, neither one of those things were secret rights or required any heightened consent requirement. So the loans were subordinated both in right of payment and in lien priority to new debt that was coming in from a subset of the creditors. And whoever did not participate was left behind, so to speak. They now had junior debt. They were no longer first in line on the collateral. They were no longer first in line in the pecking order. They were behind on this new debt. So if we want to assess whether a bond or loan is susceptible to having a Serta transaction happen, the first place we look is in the amendment and waiver provisions. Historically, first lien bonds have been more protective than loans on this point. Traditionally, not all bonds, but I would still say most bonds have a sacred right protecting either the ranking of the note or its payment priority. So that means generally, you have to check for every bond, but generally you can't change the payment priority without affected holder consent. We have seen Serta transactions happen without changing priority, just by changing lien priority. Traditionally speaking, first lien bonds have included a provision that says you cannot release the liens or change the lien priority without a supermajority 2/3 consent. So in order to pull a Serta, and we've seen a little bit of this, we'll talk about Encora as an example a little bit later, with 2/3 consent, the first lien bonds could be lien subordinated. And same thing on the loan side, you have to check the amendment and waiver provisions to see what is the consent required to subordinate the right of payment or the lien priority of the first lien loans. On the loan side, whether there's non-pro rata buyback flexibility is also a big deal. This was one of the major issues litigated in the Serta transaction. They tried to say that privately negotiated transactions fit into the open market purchase exception. Ian will talk about that a little bit more later. On the bond side, we also look for a payments for consent covenant. Payments for consent covenant used to be very, very standard in high yield and now is very unusual. Almost a complete reversal on that. A payments for consent covenant is a covenant that says if the issuer offers any consent fees or any consideration to any holders for any amendment or waiver, then they have to offer it to everyone. So we think that a payment for consent covenant would probably prevent a lot of Sertas, or at least the worst aspects of it, because it would have to be open to everyone because of the payments for consent covenant. Whether the exchange is considered the consideration or participating in the new money is considered consideration, those things would have to be open to everyone. Enabling provisions, we also have in there how much debt lien capacity is there, how much junior debt prepayment capacity is there. Because these transactions are usually done with consent, it's typically a heightened consent requirement, probably also going to get the majority consent required to change debt liens, RP, junior debt prepayment. So those things are issues we look at, but they're probably getting changed. And the consequences of not participating is, again, a creditor that doesn't participate gets left behind. You're now no longer in the first lien position. You're subordinated to the new debt. There's likely a covenant strip, so you probably don't have a lot of protections left on the tranche that you're in, and there may be other changes as well. Why don't we flip to the next slide now, and I'll throw it over to Ian to dive into the specifics of CERTA a little bit more.
One note that I wanted to make just on up-tiering generally, while CERTA obviously captured the market's attention on this, and people look at it as kind of pulling a CERTA, at Covenant Review, we've been writing on this since way back in 2008. I think we wrote about Neffs and Harrah's, both of which did coercive up-tiering transactions back in 2008. So as is the case with J.Crew and CERTA, these things have been going on for many years, but obviously it's these watershed moments that capture the market's attention.
Yeah, I would certainly agree with that. I think CERTA being so controversial was largely due to the dynamics of that particular negotiation. For those of us who remember, this was back in 2020, COVID just hit. CERTA was seriously distressed at this point, and there were actually multiple creditor groups, multiple lender groups negotiating with the company. So the issue with CERTA was that you had two different creditor groups, essentially each trying to find an advantage over the other. And the winning group is the one that was able to, quote unquote, pull a CERTA or really up-tier themselves relative to those or those lenders outside of that particular ad hoc group. Let's just kind of take a step back. What did CERTA actually look like? If you take a look at the old CERTA capital structure, it was a first lien, second lien financing. So you had first lien term loans, first lien revolver, and then a second lien term loan. And you had these two levels of priority, first and second. If you look at the post-LME structure, suddenly there's 5 levels of priority. Well, how do you get there? Essentially, what the company did is they negotiated with a majority of lenders under each of those original first lien, second lien levels. So a majority of first lien lenders and a majority of second lien lenders. Of those consenting lenders, a portion of them decided to or agreed to provide $200 million of new money. And this new money was given a first out position in the new capital structure. Then consenting lenders under both the first and second exchanged into a second out position, essentially a first lien second out position. A third out position then was slotted in right below that, consisting of, again, certain additional consenting lenders. What happens to everybody else? So the minority lenders under both the first and the second ended up in fourth and fifth out positions. And I believe they were also payment subordinated. So the end result is that if you were part of the consenting group or the ad hoc group, you found yourself in either a first, second, or third out first lien position. And if you weren't part of that group, you are in a fourth and fifth out position and very likely to recover next to nothing if the company goes bankrupt. Let's go to the next slide.
Actually, one point I'd like to add there quickly, Ian,
Sure.
is you mentioned the remaining creditors were left in fourth and fifth out positions. And correct me if I'm wrong here, but if memory serves correctly, the CERTA loans provided that supermajority consent was needed to release substantially all of the liens, but not to subordinate them.
That's correct. So that's the way that the broadly syndicated loan market works generally, is that if you want to release a lien, or specifically if you want to release all or substantially all collateral, that's typically a unanimous or affected lender consent, making it functionally impossible to do, although that's not always true. But in a CERTA transaction, what's sort of critical here is that the collateral is never released. The collateral is still there. And in fact, the lien that was put in place on that collateral in the original financing is effectively unchanged. It's still there. It's still effective. What's being changed is the priority of that lien relative to others. So what made CERTA so, I think, controversial was the idea that you could somehow lose the priority that you bought into, that you negotiated for, because another group of lenders in your class agreed to subordinate you. And that is often a core question of a CERTA transaction: is can a group of lenders essentially agree on behalf of everyone to push their priority down in a new capital structure. And what Serta showed us is that the answer is, at least at the time, often yes. And that's because, and we'll get into what Serta blockers are and how they work, but at the time, there really were no Serta blockers, except in very rare instances, which means that for credit agreements, and especially the broadly syndicated loan market, if you want to subordinate facilities, you always require at most majority lender consent. And that's because, as Scott mentioned, subordination, in order for it to be treated with a higher level of lender consent, it needs to be listed in those sacred rights. And back in 2020 and prior, the subordination, or really the ranking of the debt, simply wasn't a sacred right. There is another aspect here that, before we go on to the next slide, and that is the non-pro rata treatment, right? In order for the exchange to occur, the consenting lenders essentially swapped into the new priming position, whether that's first out, second out, or third out. And in order for that to happen, the non-consenting lenders need to be non-ratably treated relative to the the consenting lenders have to be treated on a non-pro rata basis relative to the non-consenting lenders, because you're not offering the exchange to everybody, you're just giving the consenting lenders the opportunity to exchange into the priming debt. And that requires us maybe to take another step back and remember one core feature of the broadly syndicated loan market in general, and that is pro rata treatment. So what does that mean? It means that if you are a lender of a particular term loan and everything about that term loan is the same, right, in terms of economics, maturity, tenor, pricing, if you're a lender in that class, the idea has always been that you would be treated equally to any other lender in that class. Because again, the term loan is fungible, it's the same. It shouldn't be that certain lenders get the benefit of better treatment than other lenders for no specific reason. Now, the problem is that as with everything in credit agreements, there's always going to be exceptions. And in the world of the broadly syndicated loan market, one of the key exceptions was in this idea of discounted buybacks. You are allowed, if you're the borrower, you are allowed to buy back term loan debt, traditionally at a discount from specific lenders. You could pick and choose which lenders you wanted, and that was an express exception to pro rata treatment under the credit agreement. So the Serta transaction you can think of as two components. One is that, can you do the subordination, and how many lenders do you need in order to get that done? And how do you get the consenting lenders into that priming piece? Now, this second part, what Serta did at the time is they did something called an open market purchase. An open market purchase was one of those mechanisms for discounted buybacks in the Serta credit agreement, and it was an exception to the pro rata treatment rule, which means that for the consenting lenders to be able to treat it specially, to be able to get into that priming piece without having to invite everyone else, the company had to find an exception to pro rata treatment, and they found it in this term, open market purchase. That did, of course, lead to litigation, and we'll talk about what happened to that in a future slide. But I think that's sort of the baseline understanding that everyone should have of what a Serta transaction really is. It's one, subordination, and two, how do you do the exchange so that only the lenders you want to do the exchange are given that opportunity.
One footnote I just wanted to add, Ian, you mentioned that there were competing groups of creditors, and it's interesting to note that the other competing group apparently was pitching a drop-down transaction. So that we'll discuss more in webinar 2, but just another example of various tools being deployed by creditors against each other, trying to jockey for a relative better position in the capital structure.
That's right. And this might have been the first time that I started hearing the term, lender on lender violence or creditor on creditor violence, because again, as Tony noted, Serta is not new, right? Uptiering is not new. We've seen it actually in the BSL market as well. But I think the dynamics of that lender group against lender group kind of captured the imagination in the market at the time. And certainly we saw iterations on Serta sort of immediately thereafter, notably Trimark and Board Writers, both of which also led to litigation. So we sometimes hear the term LME 1.0 versus LME 2.0, and that's very much a reflection of how up-tiering has evolved since Serta's 2020 transaction. When you think about LME 1.0, there is a sense of that rough and tumble, somewhat scorched earth approach towards up-tiering, where you have these two groups of lenders who are actively butting heads and trying to find ways to screw the other, for lack of a better term. Today, up-tiers look slightly different, at least on the surface. There's a sense that today up-tiers are friendlier and more consensual. Mechanically, they're the same. You're still looking at, well, can you subordinate? How many lenders do you need to subordinate? And how do I get the exchange to work properly? That hasn't changed. What's changed is that when you do that up-tier, since 2023 or so, often the exchange is accompanied by an offer to lenders outside of that steerco or outside of that ad hoc group. And they're given an opportunity to participate as well. So it looks a lot friendlier. It looks a lot like, oh, we're just trying to get as many of these creditors into the new transaction as possible. The LME 1.0 was really driven by the fact that Serta blocker language either was weak or just didn't exist at the time, versus LME 2.0, which has a lot of different factors kind of pushing for that new approach. From a borrower's perspective, trying to do a LME 2.0 or a friendly exchange is designed for two primary reasons. Or one is you're trying to get as many people on board because you probably want them to sign a litigation waiver. And that became a big thing after Serta because Serta, Mitel, Trimark, Board Writers all led to litigation. And so the restructuring advisors had to take a step back and think, well, we need to find a way to kind of address this particular risk. And one of them is if you can get as many people on board as possible, when they sign that exchange transaction, they'll sign a part of that transaction will include a provision that says you promise not to sue. And that will make life easier for the borrower in the future. The second reason is probably more economic. The company's just trying to capture as much discount as possible because quite often the debt that's being exchanged is trading significantly below par at the time. That's why the LME is happening in the first place. Now, I take issue with this idea that LME 1.0 was rough and tumble and LME 2.0 is friendly. In fact, I find LME 2.0 to not be particularly friendly at all. I've often said that, yes, you're getting consensus, but it's consensus at gunpoint. You are putting an offer in front of lenders outside of the ad hoc group, but that offer can, again, include things like, if you don't agree, we're going to strip your covenants. We're going to change your economics so that if any interest you are going to be paid is going to be paid in kind instead of in cash, which means you're not going to be paid interest until maturity. And of course, if you don't agree, you're going to be deeply subordinated. Economically, it can also be quite different as between those in the ad hoc group and those outside the ad hoc group. Tropicana's up-tier earlier this year, I think, is a classic example of that. Ad hoc group lenders exchange close to par. Non-ad hoc group lenders were being asked to participate, but at much lower, a much greater discount or much greater haircut from par than those colleagues of theirs in the ad hoc group. So there are ways that you can structure an LME 2.0 that, in theory is friendly, but in reality is extremely coercive and can even put lenders in a position where they're forced to take economics that might be problematic for them, not just because it's not particularly good, but also, let's say, because it's PIK. And for some lenders, including CLOs, PIK might not be something they can actually take. So there are ways to make these work, and they often are at the they benefit those in the ad hoc group very much to the detriment of those outside the ad hoc group.
I would just mention that this idea of consensus at gunpoint is also pretty prevalent in high yield, even when you have something like a payments for consent covenant. As Scott mentioned earlier, payments for consent covenant is designed to say that if you're going to amend the indenture to allow terms or restrict terms or otherwise modify the indenture, the payments for consent covenant says you have to offer it to everybody. And so there's this idea that, oh, okay, well, if there's LME and they're going to amend the indenture in connection with that, they've got to offer it to everyone. Well, it may still be a coercive deal where you're asked to make huge concessions in order to participate in the deal, but it's the difference between actually hearing the train coming down on the track and having a chance to get out of the way versus being run over by it and not realizing what happened until you've been hit. So there still is this idea of a consensus at gunpoint, even in deals that are lucky enough to have a payments for consent covenant.
So a question that was raised is, has any of this been tested in court? And the answer is yes and no. For up-tiering, litigation has been quite prevalent, actually, especially compared to things like drop-downs and double dips. Not just Serta, but Board Writers, Trimark, Mitel, and others have all been subject to litigation. Now, unfortunately, that litigation has largely bypassed the issue of whether or not you can subordinate with less than affected lender consent or affected creditor consent. And that's because, for the most part, judges have been willing to defer to the language in the debt documents themselves, and they're often pretty clear. You either need requisite creditor or requisite lender consent, which is majority, or you fall under one of those enumerated exceptions that require a heightened consent. And if subordination isn't there, then subordination isn't there. So Serta and Mitel, neither of those really address the subordination question, is what I like to think of it as. And that's unfortunate, because I think that's the one that most layman would say is the one that feels the most wrong, right? That you can somehow be pushed down in the capital structure without your say-so. What instead has been the major source of discussion, or at least the major focus by the courts, has been on that mechanic issue. How do you do the exchange? So as previously mentioned, what Serta did at the time was a discounted buyback. They called it a discounted buyback via open market purchase, although in reality it was a debt-for-debt exchange. And that is what the minority lenders, the non-ad hoc group lenders, sort of pounced on when they brought suit. They kind of made the claim that, well, this is not an open market purchase, so you cannot take advantage of that particular exception to the pro rata rule. And initially, at least, the litigation was first filed in the Southern District of New York, and the SDNY judge seemed open to that argument. And the judge did hold that, well, open market purchase is an ambiguous term, so we're going to have to discuss what that term means at trial. Now, of course, before anything could happen at trial, Serta filed for bankruptcy. And once it filed for bankruptcy, the bankruptcy court looked at this question, and the judge in that, the bankruptcy judge there said, actually, I'm going to take the position that the Serta is taking, which is that open market purchase is not ambiguous. The term is clear, and it clearly intends to capture things like non-pro rata debt exchanges on a bilateral or privately negotiated basis. At the time, I think most market observers weren't quite clear how the judge came to that decision, that the term open market purchase is not ambiguous. And of course, that is eventually the issue that came before the Fifth Circuit when it was appealed. And the Fifth Circuit followed the Southern District of New York, as well as a lot of market participants, and said, no, open market purchase, I don't know what that term means. It's not clear to me, the judges, what that term means on the face of those words. So we're going to take the opportunity to interpret what that term means. And what the Fifth Circuit essentially held was that, well, if you're going to have an open market purchase, you have to have an open market, which in this instance was the broadly syndicated secondary market for Term Loan B. What that means is that the exchange on a non-pro rata basis via open market purchase was not a correct use of that mechanism under the credit agreement, and therefore the exchange did violate the credit agreement. So this decision came down on December 31st, 2024. On the same day, completely coincidentally, another case came down for Mitel. And Mitel was actually a very similar looking up-tier exchange LME if you look at it on its face. It was, again, a first lien, second lien. There was an up-tier into new first out, second out, third out, fourth out. Everyone else got pushed down. It looked a lot like Serta. And yet the Mitel decision on December 31st, 2024, from the New York Appellate Court dismissed the claims against Mitel, Searchlight was the sponsor, and the participating lenders. So it looks like Serta and Mitel are saying the opposite thing, right? And it looks like there might be some sort of disconnect. In reality, though, I think most market observers and most market participants have come to the conclusion that actually Serta and Mitel work together fine. And that's because in Serta, the focus was on this term open market purchase. And in Mitel, interestingly enough, that credit agreement never used that term. It simply said that the borrower could purchase loans on a non-pro rata basis. And so Mitel became sort of a standard for a lot of distressed borrowers on the principle that if the credit agreement doesn't specifically say something, then you can't read into it that the credit agreement allows for things like open market purchases or what have you. So what ended up happening was that people understood that, well, Serta says open market purchases means it can't be a non-pro rata exchange. Mitel says that it can be because they didn't use the term open market purchase. And we're now in a position where as long as the credit agreement expressly allows for exchanges, it's likely that an up-tier exchange will be permitted. And we'll talk about sort of what the post-Serta, post-Mitel world looks like in the next slide. But I'm going to turn it over to Scott so he can discuss Encora.
Yeah, thanks, Ian. So Encora was a little bit different because there were first lien bonds involved in the transaction as well as the loans. And so what's really different here is, as Ian talked about, pro rata treatment being the expectation in the loans, on high yield, it's a little different. Pro rata treatment really is not the default rule for high yield bonds. If the issuer is redeeming the bonds, then yes, there are provisions in the indenture that require the redemption to be pro rata. But other than that, pro rata treatment is really not the rule. High yield bonds are, generally speaking, freely tradable securities, and the issuer and its affiliates are generally free to transact in those securities. And unlike the Serta language, it is very, very common for high yield indentures to include and high yield offering memorandums to make a point of disclosing we may engage in open market purchases, we may engage in privately negotiated transactions, we may engage in other transactions with respect to the bonds. So some of the things that came up in the Serta litigation were actually a little surprising to us on the high yield side. You know, the conclusion that a privately negotiated transaction and an open market purchase are different things seemed fairly intuitive to folks like us on the high yield side, where we think of those things as different things. You know, if an issuer says they're buying back bonds, usually we think that means the issuer is going to be in the open market buying back bonds. If the issuer is going to negotiate specifically with one holder or a set of holders, those are privately negotiated transactions, and that happens too, and that's allowed. And we're all sort of used to that on the high yield side. What was interesting on that point in Encora is that while the indenture included language about privately negotiated transactions, it allowed open market purchases or privately negotiated transactions with third parties or otherwise. And the bankruptcy court ruled that the language privately negotiated transactions with third parties or otherwise excluded transactions with the sponsor. So some of the bonds being exchanged were held by the sponsor, by an affiliate of the issuer, and the bankruptcy court ruled that did not fit in because this privately negotiated transactions prong specifically said third parties. An affiliate is not a third party. And the bankruptcy court said that or otherwise was not a sufficient catch-all. A lot of us on the high yield side were a little surprised by that. We thought the or otherwise was a sufficient catch-all. We generally thought that that language allows the issuer to more or less do whatever it wants as far as open market and privately negotiated transactions. And that's sort of where market practice is. Where the Encora decision is now is a little bit in flux again. The holdings by the bankruptcy court were vacated by the district court for the Southern District of Texas. It sure looks like that court is leaning in favor of ruling in favor of the issuer and the sponsor. A written opinion has not come out yet, so we're waiting on that. But the other interesting thing about Encora that differentiates it from Serta and Mitel is there was another LMT tactic at play that we refer to as vote rigging that also happened there. So I mentioned earlier that often there's a heightened consent requirement to subordinate liens. And the Encora bonds required consent of 2/3 of the principal amount of the first lien bonds outstanding to subordinate them. And the in-group of creditors who wanted the exchange to go through didn't have 2/3. So the tactic that was employed was those holders got together with the issuer, and the issuer issued add-on bonds only to this in-group of lenders so that they would have the requisite 2/3. The problem with that was that they didn't have the debt and liens capacity either to issue the tack-on notes. So they went to this in-group of lenders and they did a majority consent to amend debt and liens capacity to allow for the add-on notes. Once the add-on notes were issued, the in-group had the 2/3, and there was another consent given to subordinate the liens. The bankruptcy court said those two consents were really the same thing, and the issuer made a supermajority consent matter into a majority consent matter. That made sense to a lot of us. That sure looked like what they did. But again, that ruling has been vacated, and whether that particular point comes up in the new district court's opinion when it comes out is still to be seen.
I would add one comment to what Scott said about vote rigging. Obviously, that's a phenomenon we've seen in more recent years. But again, nothing new. As far back as 2017, in a coercive exchange that iHeart Communications did, they also tried to do vote rigging by issuing new debt of the same series to make sure that they can meet the applicable consent threshold. So again, we're seeing more and more of it and more creative iterations of it. But this is not new stuff. This is stuff that's been around in the market and we've seen in the past over our, 18 years of looking at this stuff.
So post-Serta, so after December 31st, 2024, what happened? Well, initially, there were those who said, well, uptiering is dead. We're not going to see it anymore. That, of course, has not happened. And the reason is that lawyers are very clever, and they're going to find ways around any decision that comes down. In fact, Serta came down on December 31st, 2024, and it took a law firm roughly 3 weeks to find a workaround to the Serta decision. And that came out of Better Health. Better Health was also a up-tier exchange. It had open market purchase language, or allegedly had open market purchase language. So the question became, well, how are they going to do this up-tier? Because the consenting lenders can't flip into the priming debt. And the mechanism was actually quite clever, if you want to think of it that way. The ad hoc group was still there. It was still a majority. And what they did was they agreed to extend their maturity. Now, extending your maturity is a sacred right. In order for you to extend maturity on any lender's debt, you need to get that lender to agree. And so what the ad hoc group did was they agreed to extend their maturity as opposed to anyone else's. The end result, however, is that the ad hoc group at that point becomes its own separate class. So going back to pro rata treatment and pro rata sharing, the rule is generally that lenders of the same class must be treated equally. If you can somehow separate the ad hoc group into its own class, then at that point, you don't really need to deal with stuff like open market purchases or exceptions to pro rata treatment. You just flip that ad hoc group into the priming position, assuming that it complies with any sort of Serta blockers, and then you're good because you haven't treated the ad hoc group on a non-pro rata basis relative to everyone else in the class because they're the only ones in their class. So that's a long way of saying that there was a clever mechanism in the credit agreement that allowed the company to do an up-tier, even though it had open market purchase language. We've seen this done in a couple of other instances, notably Oregon Tool, which was a few weeks after Better Health. So again, in Q1 of 2025. We've seen other workarounds on the open market purchase point, including what I call an add-on exchange, very similar. This was in Confluence, where the ad hoc group incurred incremental debt under the accordion as, again, a separate class, and then that class flipped into the priming position. And then lastly, we've seen an instance of what's called bootstrapping. Essentially, you simply modify the open market purchase language at the time you do the LME to say open market purchase and or privately negotiated buybacks or something along those lines. So as long as you change the open market purchase language so that it allows for a private negotiation or a private exchange, and you do that with majority lender consent, then you can do the exchange thereafter. Now that will require some predicates to kind of fall into place, including in this particular deal, it's a private one. They were able to do this because pro rata treatment itself was not a sacred right. So you could actually modify pro rata treatment with just majority lender consent. But there's going to be many ways around Serta to the point where I think most lawyers and restructuring advisors don't see Serta as a significant hurdle to do up-tiering anymore. It is an additional obstacle that has to be surpassed, but it's not a particularly difficult one if you're really incentivized to do so. The biggest change, I think, pre and post Serta is how new issue debt is drafted. Pre-Serta or pre-Serta decision in 2024 anyway, often the case, you just see the phrase open market purchase. So very similar to the 2020, actually it was 2016 Serta credit agreement. And if it just said open market purchase, at the time, prior to the Serta decision, the thought was that that was sufficient to allow for exchanges. After the Serta decision, it was thought that it was no longer sufficient to allow for exchanges. So post-Serta decision, what do you see? The credit agreements now say things like, again, open market purchase or privately negotiated transactions, or sometimes they go the Mitel route and simply not say open market purchase at all. Both of those are designed to do the same thing. It's designed to retain flexibility to do a non-pro rata exchange, potentially in an up-tier context in the future. Next slide. So what has been the market response to up-tiering generally? The primary response is, I referenced it a few times earlier, it's what's referred to as a Serta blocker. A Serta blocker is a provision that is within the amendment section that essentially makes it a sacred right to prime or subordinate any existing debt. So whereas prior to 2020, most credit agreements in the broadly syndicated loan market did not have Serta blockers, which means that you could subordinate with majority lender consent. After 2020, the majority of new issue documents started putting in these provisions that said, actually, we're going to require either affected or unanimous lender consent in order to subordinate. That's the general idea. Unfortunately, it's rarely that simple. Most Serta blockers are going to be drafted by lawyers, so they're going to find ways to either weaken or build in exceptions into that protection. So common exceptions today, you will typically allow for priming in the context of dips. You will typically allow for priming so long as you offer the priming position to affected lenders. Often you allow for ABLs, securitizations, and sometimes other exceptions. From a lien subordination perspective, often the Serta blocker is limited to all or substantially all collateral, which means that you could, in theory, subordinate on a portion of collateral with, again, just required or majority lender consent. This third one can be actually quite problematic. Sometimes the Serta blocker only applies to a particular kind of subordination. So it'll only require heightened consent for, let's say, payment subordination, but not lien subordination, or vice versa. But the end result is that you could potentially still do an up-tiering with the other kind of priority, right? The other kind of subordination is still open to be done via majority lender or majority creditor consent. And in fact, we did see that in the recent Sachs up-tiering. Lastly, sometimes you'll see subordination with majority consent if it's otherwise permitted in the credit document. So what does that mean? Well, it means if you put in something into your debt and liens covenant, again, building in future priority capacity, can that then be done with majority consent? And in theory, yes, you could, right? Because it only requires majority lender consent to change the negative covenants. Now there's an exception in the Serta blocker allowing subordination with majority consent. If it's otherwise permitted, it is now otherwise permitted, and the up-tiering can proceed. So there's, again, many, many ways to get around even those protections that I think lenders expect these days, right? If you're a syndicated loan investor, you're almost certainly going to ask for a Serta blocker if it's not there. But unless you pay attention to exactly how it's drafted, there are going to be ways around it. And we have seen different companies do up-tierings utilizing these particular weaknesses. Interestingly enough, the market response was fairly muted when it came to the other part of the Serta transaction, which is non-pro rata buybacks. There were a few deals that did try to push additional protections here, either saying that if you're going to do a buyback, it has to be for cash, so you can't do debt for debt exchange, or maybe you explicitly prohibit things like privately negotiated transactions, or sometimes you even limit buybacks to so-called Dutch auctions, which are a different kind of buyback, but one that is offered to everyone in the class. There was a low uptake in the BSL market on these kinds of provisions, and we've largely seen the opposite, which is expansion of buyback flexibility, even while Serta blockers are being asked for at the syndication phase. Next slide, please.
So here are a couple of examples of recent of some historical up-tiering transactions that we've seen. We won't go through them item by item because we'd like to save some time for questions. I would just note that in a number of these, you are also seeing some other LMT components added in, whether it's iHeart, which involved both an up-tiering and a drop-down LMT alternative structure. Lumen Level 3 involved both up-tiering as well as a pari plus kind of component, and Bausch Health's 2022 LMT that involved both up-tiering and drop-down components. But I would strongly recommend that everybody on this call please look at the liability management transaction quarterly report that Ian prepares, because it's got a pretty comprehensive list of these transactions organized by LMT structures. So would definitely recommend that if you want more granular detail on where we're seeing these kinds of transaction structures. So with that, we were thinking we would open it up to any questions and answers. If questions, we provide the answers, hopefully. Let's see what we have here. There's a question about substantially all. What is the threshold of substantially all for lien subordination? And that's an interesting one. I don't know if Scott or Ian, you want to weigh in on that, given that these documents are generally governed by New York law?
The answer is it's very hard. It's not easy to pin down what substantially all means. It is very much a case-by-case determination. There is no objective standard. It absolutely, in the question, the person asking the question says, could it allow for up to 70%? You know, potentially yes, or it could be less, or it could be more. It very much depends on different factors that the courts have said substantially all consists of, kind of beyond the scope of this particular session, although we do have some research on it that we'd be happy to share offline. Okay, there's a question, would love to see actual Serta language. I can reach out, again, offline, but there's many examples out there, both in terms, well, the Serta loophole language is simply the absence of the reference to subordination in the amendment section. So it's hard to show that, but Serta blocker language, we have research on our site that I can share offline as well. Here's a good question. When considering sacred rights, what is the difference between all lenders and all affected lenders? Often it's the same. And functionally, it's often going to be a question of what's being changed. So if you're changing something like collateral or that secures everybody, then all affected becomes everybody. Now, the way that the language is actually drafted in most credit agreements is it's not just all affected, it's all lenders who are adversely and materially affected or something along those lines. So there can be a distinction between a lender that is adversely affected and everybody who is just affected. That has not been a point that has been really litigated to any specific degree. So it's hard to say exactly what that difference would be, but there is a potential difference when you really dig down into it in terms of, well, is this person being adversely affected, which would of course be the case if you're losing collateral or priority or something like that, and whether or not you're just affected, perhaps indirectly, by a change in the credit agreement.
I see that we have a couple of questions asking about a list of high yield deals that are lacking Serta blockers, or is there a standard way to identify the blocker language? And I thought I'd plug our new template, which we launched a year ago in September, where in the front pages, we try to identify quickly for our subscribers what kind of Serta protection there is. Is there Serta, what is the threshold for subordination in respect of lien priority and payment priority as kind of a handy, quick reference point for people who are looking to get that answer quickly. Obviously, you got to look at the language itself and kind of look at what exceptions there are. And some of the lawyers are actually being very creative with the kind of exceptions that they draft for Serta blockers. So sometimes those exceptions can swallow the rule. I would also briefly note that, you know, the default rules that you see in Serta protection can vary among asset classes, whereas in leveraged loans, you may tend to see a significant percentage that have all affected lender consent, but plus a laundry list of exceptions. While in high yield, you may see a lot of these instruments coming out with supermajority consent with no exceptions. So the question of what is the tighter threshold really is up for debate, and it depends largely on the structure of the transaction that you want to do in those deals. I think we are running out of time. So I did want to take a moment to thank everybody for participating in today's webinar episode. And thanks for a great conversation on this wonderful topic. We look forward to seeing you all in our next installment, which we're going to do a week from today, and where we'll be taking a closer look at drop-down liability management transactions.